Stephen, why don't you take it away and tell us a little bit about let these students know how you got into this business after graduating and what that path looked like, and then introduce Willie.
That sounds great. Thank you. Thank you, Barb. Good afternoon, everybody. Thanks for allowing myself and Willie to be a part of this and do a little Q&A, which hopefully will be beneficial to you all. And feel free to ask questions at the end, as Barb mentioned. As Barb mentioned, I graduated a master's program in 2002, then called, I guess, real estate and construction management, real estate finance and construction management, now real estate in the built environment. But excited to see what the direction Barb's taken the program and wanted to reconnect. And hopefully this will be first of a couple of times I'll be able to interact with students going forward. Willie Walker is our guest here today. Willie is the CEO and chairman of Walker & Dunlop, a terrific leader and a good friend of mine. I'm proud to say I joined Walker & Dunlop in 2009 at really maybe 3 or 4 months after the kickoff of the Great Recession, if you think about the timing. And it was a very, very symbolic of the fact that Walker & Dunlop made an investment to merge with a company. I was working with Column Guaranteed, which is a subsidiary of Credit Suisse at the time. And it was really Credit Suisse's last kind of remaining real estate business that had some bit of profitability kind of associated with at the time. And Willie and Walker & Dunlop merged, technically merged, but really it was an acquisition of sorts. Walker & Dunlop then rebranded a year later, or within that year rather, into the Walker & Dunlop. Walker & Dunlop was a parent company of Green Park Financial at the time, and went public in 2010. So since that time, and really through that time and on forward, we've gone through just tremendous growth. Our stock price, not that we really track it very much, or certainly I don't, tipped over $100 a share last week, which is really a milestone that any one of us that work at Walker & Dunlop are very proud to see. But Willie is now living in Denver, moved his family out to Denver about a year ago, and runs our company and has been, like I said, a tremendous leader. And so hopefully today we'll get a chance to talk a little bit about the market, a little bit about new investment types and kind of methods in the market today, and then talk about innovation, because there's a lot that I think there to share with you all about what Walker & Dunlop is doing. So I'll kick it off, Willie. If I've got a number of questions here, and certainly we'll maybe ad lib a little bit as we go through it. So Willie, kicking it off, what is your perspective on the real estate market at a high level today, and how has it weathered the pandemic?
So let's see, Stephen. First of all, thanks for the intro, and it's nice to be with all of you at DU today. And as it relates to the pandemic, you have to kind of look at it in various asset classes, as you know, Stephen. So the worst hit asset class is probably hospitality. You don't really want to be an owner of hotels today, but many are still owners of hotels, and the hotel industry will come back into the summer and into next year. The next worst is probably retail, unless you own big box retail. If you have a strip mall that was losing tenants, and retail has kind of struggled through the pandemic, other than big box retail, which clearly Walmart and other big box retailers have done quite well. The middle asset class is office, where people are kind of scratching their heads on what happens to offices. I'm in our office here in Denver today. There are probably seven of us in the office, and we typically have about 45 people in here, not pre-pandemic. So office is one of those ones where, because they're long-term leases, people, Walker & Dunlop has 44 offices across the country, and we're still paying all of our leases. So while there are question marks about the future of office, most office buildings are still getting tenants paying at a very, very high level, and therefore office as an asset class has held up quite well. The next is multifamily. People need somewhere to live. The pandemic, although there's been forbearance put on Fannie, Freddie, and HUD loans, both single family and multifamily, by the federal government, although there have been eviction moratoriums, which have shown an uptick in bad debts and people not paying for their rent. All of that has been relatively minor to a very healthy multifamily market, because people have to live somewhere, and people have continued to pay their rent. And then the final one, which has done exceptionally well, is industrial. And because everyone sees Amazon and other online retailers providing more and more goods and services to our homes, industrial has done exceptionally well and continues, I think, looking forward to do very well. So the final thing I'd say, Stephen, is that we are in a yield-starved world. The debt markets are returning to people. In many instances, sovereign debt has got negative yields to it. AAA corporate debt, there are not too many AAAs out there anymore, but what they're paying out as it relates to the yield on their AAA bonds is extremely low. And we have people, as the population ages, who need current income. People need dividends and they need debt to come back to them. And so because the debt markets are so low right now, many people look to commercial real estate as the opportunity to get an income producing investment, which pays like a dividend yield. And so there's a lot of capital that's looking to be deployed into commercial real estate because it is a income generating investment. And as a result of that being in this low yield world, we're getting a lot of equity capital coming into the markets, and that's very healthy for the outlook.
That's great. Yeah, I'm going to come back to the equity as you point out there, Willie, because I think there's some interesting things to talk about. But as many of you may know, if you've done some research on Walker and Dunlop, our focus is real estate finance. I should have mentioned that going in. And we do asset management, both from a capital standpoint as well as a loan portfolio, and a lot of multifamily, being Fannie Mae, Freddie Mac, and HUD being our three largest multifamily lenders, and of course we service for life companies as well. Willie, how has the pandemic impacted single family versus multifamily industries? And we'll get into a little bit of the build for rent and single family rental business, but just in general at a high level, single versus multi right now.
So singles had an incredible run since the onset of the pandemic because everyone wants to live in a detached single family home. The problem is that not everyone can afford to live in a single family home detached. And so as a result of that, what you've had is the inventory that was out there got gobbled up very, very quickly. And you had two big migrations that happened last summer, people moving from the urban core out to the suburbs and people moving from multifamily into single family where they could afford to do so. What you now have is the single family housing industry is building as much inventory as they can possibly build, but they can't build it fast enough. There's well more demand today than there is supply of new single family homes. What that's done is pushed up the cost of the existing inventory. So any relatively affordable single family home that was on the market is appreciated 20 to 30% since the beginning of the pandemic. So if you were somebody who could barely get into that starter home and be able to make the down payment and be able to pay the interest expense on your mortgage, that's now moved away from you. And so what we saw in the last 9 to 10 months is a big move towards single family, but the legs behind that, how long that lasts for, I put a big question mark behind, because those people who were able to move, moved, and the other people really, quite honestly, can't afford to move. That's why single family rental is such an interesting asset class, is that it's sort of, it's right in between multifamily to single family. The desire to live in a detached single family home still exists, but many people can't afford it. Single family rental gives them the opportunity to live in a detached single family home, but pay for it like they're paying for an apartment. And so that's a space that's gotten a ton of capital. It's got a ton of development going on. And I would say over the next 10 to 20 years is a real winner as it relates to the asset class meeting the need of consumers, in the sense they want that product, but they can't afford it as it was traditionally offered to them. Single family rental presents it.
And how do you think the return to work has an impact on that business of single family versus multi? And then maybe more specifically as well, when you talk about the return to work, is what is Walker and Dunlop? What's our plan, and what do you think trends and shifts that we should expect to see across the country?
Yeah. So I think that, first of all, it's way too early to really tell. I will tell you this, that there are a lot of people at Walker and Dunlop who just are enjoying being home. They don't have to be in the office. They want to keep working remotely, and they've gotten accustomed to it. I'm in the office, as I said previously today. There are probably 7 people out of 45. People in our Denver office know that I'm in the office. You'd think that they might want to show up because I'm here, and guess what? They're not. That says they like working remotely. but we will not come back into the office until at the earliest June 15th. We put that out there so that people could move from New York to Boise, Idaho and work remotely and move towards family members so they could take care of kids if they didn't have the kids in either daycare or elementary school, because many of those services shut down. And so we allowed people to have flexibility. But to exactly what you're asking, Stephen, when we say everyone back in the office, those people who move from New York to Boise, Idaho have to get back to New York. That's where their job with Walker and Dunlop is. And I'm a very firm believer that culture and creativity happen in the office. We've been wildly productive at Walker and Dunlop, absolutely wildly productive since the pandemic hit, had a record year in 2020. So you'd sit there and say, well, what's the problem? The problem is the culture that makes Walker and Dunlop such a great company is very hard to maintain virtually. You and I, Stephen, we go on annual ski trips together. We go on annual fishing trips together. We spend a lot of time with clients. We do tons of stuff where I see you. I haven't seen you in a long time.
Yeah.
And you were supposed to be with me in Sun Valley last week skiing and you couldn't make it. But the point being is that there are things that make you and me have our relationship, that makes you an integral part of the Walker and Dunlop team. And without that, you and I could last for another year, maybe another 2 years, and our relationship doesn't get degraded. But when you do it on scale, it does. And so I think that culture and then creativity, the other thing that I think everyone on the Zoom call knows about is that in the corporate world and also in the classroom, we show up with an agenda. You and I have our conversation here today, and everyone's either listening and thinking about questions or not. But there's very little opportunity for that sort of off the wall question to come up. Just kind of, you're sitting there talking to somebody about something and you share with them a personal thing that just happened, and it spurs a thought that then leads to a conversation, that then leads to something that you might think about from a business standpoint. That type of creativity doesn't happen on Zoom. No matter how good you are, no matter how many people or friends feel comfortable raising ideas, it just doesn't happen. And so unless you create an environment to let that happen, you basically do the same thing over and over and over again. So we will be back in the office, and those people who moved to other parts of the country are going to have to get back to the office that they've been in, or ask us if they can move to another office. So I'm a firm believer that it all snaps back. The final thing I'd say is that there are lots of people who say that the overnight business trip is gone forever, that you or I, Stephen, will never have a deal in LA, one meeting, fly to LA, do the meeting and spend the night and come home. I completely disagree.
Yeah.
Because if our competition is going to go and meet with that client face to face to win that deal, that's the competitive landscape that you and I must compete on. And so right now it's a Zoom landscape. So you compete against everyone on Zoom. That's great. That's fine. But like the client ski trip I did last week that I wanted you to come on and you couldn't, that was a very unique experience with those clients, because they're not doing that with anybody else. And the moment that one of our clients hears that those clients came to Sun Valley to ski with Walker and Dunlop, that's a competitive advantage to that relationship. So everyone's going to push to try and do the same thing. So this idea that like the overnight business meeting is gone and that the JW Marriott hotel is never going to have the same occupancy that it once did, or that United Airlines is never going to get that last minute booking for a business class ticket, I say complete bullocks on that.
I'd agree. I mean, as you know, I live in New Orleans, and I've been doing originations for nearly 20 years. And for the first 5 years, I was basically flagged to go secure the Freddie Mac franchise. At the time, they were very, very specific license per state, if you will. And we were on probation effectively for Louisiana and Mississippi, which are not high volume states, as you all might imagine. So early in my career, my focus was on Louisiana and Mississippi, securing the Freddie Mac business license in those states. Since about 2009, I'd say 5 to 10% of my business is in Louisiana and Mississippi. 90 to 95% of my business is across the country, and I'm on airplanes, either seeing real estate or meeting with clients, as Willie points out. So as an originator, my job is to know the numbers exceedingly well and to travel and be with clients, because quite frankly, there's plenty of people out in the country that know numbers just as well as I do. But the hope is that I can bring the relationship and the lenders and understand the needs of a customer and be compassionate to that in a more meaningful way. Willie, talk a little bit about tax policy, if you would, and sticking with the market and what impact that might have on blue-red state migration, and how does that impact where maybe people are investing in real estate today or going forward?
Significantly, Stephen. I think that we will see if the Democrats, now in control of the White House, the House and the Senate, change the tax code so that you can deduct your state taxes from your federal taxes, which was the big change that really accelerated this shift in migration patterns. But the high tax states, New York and California to be the two most sort of acute, and the low tax states of Florida and Texas are benefiting and losing accordingly. And we're seeing it. We're seeing corporations relocate to Florida and to Texas and other low tax states. And we are seeing people move with those jobs. And so it has a lot, I mean, it has a very long tail to it as it relates to where people are moving. The other thing that's kind of interesting about it all is it's going to change the politics in America. Every single day that Texas keeps attracting California jobs makes Texas become more and more of a blue state. And every single day that Florida continues to attract New Yorkers, it becomes a bluer and bluer state. So it's very interesting as it relates to these quote unquote, red states with low taxes that had traditionally more conservative populations are getting this big immigration of blue state residents who are leaving the blue states because of taxes, but they're going to start to change the politics in those states. And so we're seeing it in where properties are being sold, the prices at which properties are being sold, and where people want to live. And it has a big impact on the multifamily industry.
Has that had any impact to how you've Walker and Dunlop Investment Sales is not a subsidiary, but is a division within Walker and Dunlop as our investment sales department. Have you all spent time focusing on where you want to grow investment sales brokers because of that?
Well, yeah, the quick answer to that is very much yes. I would also say that the three markets right now where we are not and we must be with that service offering. So this is us acting as a broker to sell multifamily properties. So if somebody owns a student housing property right near the campus of DU and they want to sell it, they will hire a firm like Walker and Dunlop, CBRE, or JLL to take that property to market. And so we have teams of brokers who go and list those properties and then run the whole auction process and then work with the owner to pick who the buyer is going to be. And often Walker and Dunlop acts as both the broker on the sale and then the financing for the acquisition. And so the three markets where we are not, where we still see huge inflows of people is Phoenix, Arizona, Denver, Colorado, and Seattle, Washington. And so those three markets we are not in today, but we are fortunately in Austin, Texas in a very big way, which is the hottest market in the country. We're very big in Dallas. We're very big in Houston. We're very big in Miami. We're very big in Orlando. We're very big in Jacksonville. We're very big in Nashville. We're very big in the Carolinas. So in a lot of the places where we're seeing migration flows, we have a very strong team on that front, but that we do, as you know, Stephen, have a couple pockets that we need to fill.
Yeah. So let's switch into investment types. We touched on, and maybe just expand a little bit for the audience here, single family rentals and then build for rent and the flow, how we're gearing up for that, and how what are you seeing that causes Walker and Dunlop to focus on this segment? I guess we touched on it a little bit, and then the capital around it. And then I guess further, will that have a negative impact to multifamily, traditional multifamily, conventional housing?
I think it's the punchline on will it have a negative effect on multifamily is the fact that there is not enough supply of either single family or multifamily housing in the United States. And as a result of that, there is huge pent-up demand for both products. So it's not a zero-sum game that every single family home that's built is going to take a renter out of a rental. There's obsolescence in both multifamily and single family, and there is a real need for hundreds of thousands, if not millions of units on both sides. So I don't worry too much about single family pulling out of multifamily. On single family rental, as I said previously, it's just the confluence of the two business models, if you will. It's providing a product that everybody wants in a financial structure, if you will, that people can afford. And that is going to, I think, attract many, many people. But the other thing, Stephen, that I would underscore is that the whole reason that Walker & Dunlop's office in Denver is where it is at the corner of 17th and Lawrence is so that DU graduates who want to get out of DU and go work for a firm like Walker & Dunlop can live in the urban core. They can rent an apartment. They can start a family. They can have access to all the great things that are in the urban core. And those desires haven't gone away. So the concept that everyone's saying, oh no, I don't want to live in downtown in an apartment, I'm going to go buy a home in Parker when they've just graduated from DU. I mean, that's not going to, it doesn't happen. I mean, there might be a family on this Zoom call who says, no, we're starting a family. We want to get to Parker now and build a life there. I totally get that. But the majority of young college graduates move to a major urban center where they're going to get access to great jobs and they're going to have access to social life, culture, and community. And the pandemic hasn't sort of gotten rid of that. And so I'm still, as much as some of the big urban core multifamily operators have seen their occupancy levels come down quite a bit and their economic vacancy numbers spike, I'm still a big believer that the urban core is something that's going to be very attractive. People are always going to want to live in New York City, always. San Francisco, I think I do put a question mark around San Francisco right now, just because it's got high taxes. It doesn't have the same sort of, it's got an odd cultural mix to it, if you will, only in that it isn't like New York from a setup standpoint. And a lot of the jobs in San Francisco are sort of extensions of Silicon Valley, and Silicon Valley is putting jobs in other places in the country, as we've seen from Amazon and from Google and a bunch of other places. And so I put a question mark around San Francisco, but places like Boston and New York and Washington, D.C., other sort of gateway, Seattle, gateway, relatively speaking, blue cities, I think they've got a great future.
Yeah. And so switching a little bit to the equity, which we touched on earlier, equity capital, certainly over my career has become, in the multifamily space, is definitely become more institutionalized than previously. Do you see that across all asset classes, a more institutional nature of equity in commercial real estate?
Yeah, no doubt. Today, the number is about $140 billion of private equity capital focused on investing in commercial real estate in North America. So that is a huge amount of equity capital, because if you think about the debt to equity ratio in most commercial real estate deals, you're putting somewhere between 20 and 30% equity in to the deal, and you're getting 60 to 70% debt. So there's a huge amount of what we call dry powder in the institutional private equity funds focused on investing in commercial real estate in North America. The Reit market has continued to grow as it relates to publicly traded both asset owners like Equity Residential and Boston Properties, which is one in multifamily, the other one in office. Prologis, based here in Denver, which is in the industrial space. All of those companies are big REITs. They raise a lot of capital. You see this continued sort of transformation of commercial real estate from being owned by individuals into what I call institutional families, into private institutions, into public institutions. And as you get greater and greater transparency, as you get more and more transaction volume, and as you get more and more capital flowing into this industry, that will continue to evolve to being far, far more institutionalized. And I wouldn't be surprised if by the time, I'm trying to give a marker here, I'd say in the next 20 years, we probably have a stock market for commercial real estate, where there's a freely traded market on properties in the United States. And it's not just publicly traded REITs that have a quote to them. I think buildings will be listed. I think you will have a robust market for commercial real estate properties within the next 20 years. Maybe it's the next 10 years. But that will drive this industry very much the way that it's driven the broader equities market with back, Stephen, when you and I were getting out of college, there's a relatively small firm called Charles Schwab back then that said, we're going to do discount brokerage. And to all the students on this call, you all think about E-Trade and Robinhood and all these other discount or no fee brokerage firms. Back when Stephen and I were your age, if you wanted to trade in securities, you had to have an account with one of these Wall Street firms. You had a banker who covered you, a broker who covered you, and you paid very high commissions to trade a share of General Electric or IBM or something else. The whole concept of the transparency, low fees to no fees that we see today in the public capital markets for equities 30 years ago was nothing close to that. And I see that same migration, if you will, happening in the commercial real estate space that happened in the public equity space.
Well, and as you know, I do and have done over the past, probably 6-7 years, especially kind of 2013 to 2018, did quite a bit of value add multifamily, a lot of repositioning of assets, probably did as much either high leverage lending there or marrying up pref equity with senior mortgage debt and on a lot of transitional real estate. And that started off as a lot of private funds. And over that time, we saw a lot of the institutional equity coming out with, funds geared towards that value add. As we sit here today and post pandemic, and we touched on office and retail, where do you see opportunities or new innovations occurring? I know Walker and Dunlop Real Estate Opportunity Fund is maybe even taking a look at an investment in a hospitality conversion to multifamily. Can you maybe speak a little bit to that and any other opportunities and new innovations you're hearing and seeing about?
Yeah, I'll broaden that a little bit, Stephen, and just sort of where should people on this call think about starting a career, creating a career in commercial real estate? There's a lot of opportunity out there always, depending on, as Stephen was accurately saying, depending on where we are in the cycle. Are we on a downdraft? Are we on an updraft? Where is there pain? Where's the opportunity to make outsized returns or consistent returns? And I think one of the biggest things is that each one of you on this call needs to kind of figure out what interests you and what excites you on a day-to-day basis, and really understand who you are as a person. Because on this call, there's going to be somebody who has a very, very high risk appetite, might have a nest egg that you've either earned or inherited from your parents, and gives you the ability to go from a financial standpoint and take a little bit more risk than a classmate who doesn't, who might have some student debt that needs to get paid off and is looking at a very different sort of first 5 or 10 years out of DU. So the first thing is to look at yourself and what's your risk tolerance. The second thing is there are people who want to be in the transaction business, like Stephen and I are. We interact with clients every single day, but we are service providers. Stephen does not get a day off from the client calling his cell phone saying, I need you to work on this, or why isn't my deal going the way I thought it was, or where are rates right now? Never. That cell phone is on 24/7, and not that anyone calls him up typically at 2 o'clock in the morning, but if they did, he'd pick up the phone. There are other people who really want to be a principal. They want to own. They're like, I got to go own something long-term. That's where I want to be. So that's going and trying to get in on the equity side of ownership. And that might be with a small group where you're being a little bit more entrepreneurial and trying to find those opportunities, or it might be with a big group like Blackstone, where if any of you go to work for Blackstone, A, you'll work super, super hard. B, you'll learn a ton. C, you'll get paid really well, but you're working 7 days a week, 10 to 12 hours a day for the first couple years before you are either realizing that you've made any money or seeing a lot of friends. That's just the nature of the beast. But at the same time, what a great training ground. And many, many people go there and then move on to go do what they're going to do after that. And then the other side of it all is on the financing side, whether it's with Wall Street firms, life insurance companies, banks, or specialty finance companies like Walker and Dunlop. And so identifying kind of what you like doing, what your core skill set is. And the other thing about it is trying a bunch of different stuff. If you come to work at Walker and Dunlop, you say, you know what, that Stephen Farnsworth seemed like a really good guy. and my sense is he makes a whole lot of money, which he does, that'd be something that I'd like to try and do. Well, you go try it. And after doing it for a summer or for a year, all of a sudden you say, you know, that's kind of cool, but not really what gets me. When I got out of undergrad and out of business school, out of undergrad, I wanted to go into investment banking. I didn't go to investment banking out of undergrad. So when I went to business school, between years at business school, I went to investment banking and I worked at Morgan Stanley. And I realized at Morgan Stanley that I was a pretty good investment banker. They gave me a job offer to come back, but I didn't really like it. That experience of 3 months figuring out that I didn't really like investment banking was an invaluable experience for me. I would never look back and say I wasted a summer at Morgan Stanley because it wasn't moving me towards Walker and Dunlop or anything else. It was, a lot of things in life you learn from bad experiences as much as you learn from good experiences. My worst boss ever, I worked for him for 5 years. Awful guy, awful. I learned more from him of what not to do in business, which helped me be better in what to do, than I learned from a lot of great bosses about what to do. So I would just say, get out there, try different things, think about what you're good at, where you want to be, what kind of environment you want to be at. And the final thing I would say is this: Walker and Dunlop is somewhat unique now in that we have big company capabilities. Our competition on a day-to-day basis is CBRE, Wells Fargo, and Goldman Sachs. Those 3 firms we go up against every single day. And all of them have huge market capitalizations in tens of thousands, and in some cases, hundreds of thousands of employees. At Walker and Dunlop, we have 1,000 employees. So if you're at Walker and Dunlop, you have the ability to provide big company capabilities with a small company touch and feel. That is a very unique combination. Many of you will go to work for either small companies or big companies. And I would just say, if you can find a company that has those 2 things, it really is for us today a very significant competitive advantage as it relates to recruiting people, retaining people, and growing our company.
Yeah, no, great segue too, Willie. I'm going to touch on innovation a little bit and what Walker and Dunlop is doing there. And I think, the COVID experience, if you will, has been great fuel for us to question everything we're doing. I guess, to put in, not my words, but many within Walker and Dunlop, and been on many grouping Zoom calls just to touch base with employees every couple of months, kind of breakout sessions, if you will. But what tech innovations have we implemented, and even some date back prior to the pandemic, and where could Walker and Dunlop continue to innovate? If you could touch on that for a little bit.
Yeah. And I do want people formulating questions, because it'd be fun if Stephen and I can open it up and get people just asking questions, because Stephen and I could keep talking about all the things that he and I do every single day together. And it's fun for me, and it's, I hope, interesting to all of you, but I'd love to hear your questions as well. We've made some really significant investments in technology. We started investing in databases in a very significant way 4 years ago. A year and a half ago, we started applying machine learning to those databases, and that has allowed us to supply bankers like Stephen with what I would call actionable data and insight that is, quite honestly, transformed, revolutionized the way that Stephen and other bankers and brokers go to market. And without getting too much into it, we basically know as much or more about our clients than they know about themselves. And so when you're in the sales business, when you're trying to get someone to work with you the way that we try and get people to work with us every single day, being very knowledgeable about your customer is job one. And when you can have as much data and insight as we provide our bankers and brokers about their both existing as well as potential clients, that's a real game changer. So to put that into numbers, with this new technology that we've developed over the last 4 years, but really rolled out in 2020, in 2020, 67% of the loans that we refinanced at Walker and Dunlop were new loans to Walker and Dunlop. So if you think about what we have, $108 billion loan servicing portfolio. So we have thousands and thousands of loans that aggregate to $108 billion of loans sitting in the portfolio. Every one of those loans we should refinance, because they're in our portfolio. We've worked with the client. loans coming up for refinancing in 2021, we're idiots if we can't go get that refinancing. But in 2020, 67% of our refinancings were with new loans to Walker and Dunlop. That could either be with a new client or an existing client, but it's a new loan to us. So those data analytics gave us insight into other loans that other lenders had done with clients that we went out and got. And then in 2020, 23% of our total lending volume, as well as property sales volume, was with new clients to Walker and Dunlop, 23%. Again, that's knowing where opportunity sits and using data to find that opportunity. So we've made big investments there. We're right now entering into the small loan business. So our average loan size in 2020 was $22 million. We're moving into the small loan space of less than $5 million loans. So these are multifamily properties that have, some of you may be living in a 4-unit multifamily property around DU's campus, or a 10-unit multifamily property. We want to lend on those properties. But to do so, we need to change the way we go about doing business. To be blunt about it, I can't afford to pay a loan originator the amount of money or the percentage of the fee that I pay Stephen when the loan's only a $2 million loan. And I also can't afford to pay the underwriters who do the credit analysis on that loan the same amount as a loan that Stephen's doing that's a $45 million loan that we have to do an extensive underwriting package on. So that changes the dynamics of the business and requires us to put a significant amount of technology to that business. And that's what we're doing right now. The final thing I'd say is that next Wednesday on the Walker webcast, which I do every single week, I have two really savvy, smart, successful property technology and financial services technology venture capitalists from Camber Creek is one of the venture capital firms, and the other one is Fifth Wall. And I have the two CEOs of those firms coming to join me on the Walker webcast next week to talk about property technology and financial services technology. And that discussion will be a really interesting view into where is technology going as it relates to technology at the property level and technology at the financing level that's going to change the way we go about doing what we're doing. And I could bore you for a long time, Stephen, on all the different things that we're looking at inside of Walker and Dunlop, from investments on prop tech and fintech, but let's just suffice to say we're doing a lot.
Yeah, no, absolutely. I can rattle off a couple things that from Apprise, a new appraisal division that we started last year that gives us incredible insight. It's Willie, maybe take a minute or two to differentiate Apprise versus other appraisal groups out in the market, because you probably do a far better job of explaining it than me, but huge.
Yeah, I'll do it real quick. So the way an appraisal is done, and some of you may decide to go be appraisers, is that you hire a person who works at CBRE or Walker and Dunlop. That person has a team of people who pull together all the documentation on the building that they're appraising, as well as 4 or 5 comparable buildings near that property. And so that data aggregation compilation process is very labor intensive and takes a heck of a lot of time and energy to pull it all together. What we've done with our appraisal business is we've automated all that. So rather than having a bunch of analysts pull all that together, we're using various data feeds. We have created algorithms, and all that gets pulled together automatically. So what we've done in the data analysis part of this is not only automate all of it, but then create a huge database that allows us to go and take that data and run it against the market at a much wider level. So one of the interesting things that's come out of all this work is that in the past, when Stephen would have a property he's lending on in New Orleans at Main and Main, the appraiser would go in, look at that property, and then go find another 3 or 4 properties within half a mile radius of that Main and Main property. And those are the comps. Those are the comparable properties to value. What the technology now allows us to do is to sit there and say, we're looking at a property at Main and Main in New Orleans, but the closest comp to it, given all the data points we're looking at, is actually in Seattle, Washington.
Proximity to Starbucks, where your nearest Whole Foods is, you name it.
You name it. Unit size, HVAC system, key card system, dog walk, all those things come in and are used to basically say the closest value to this property is not down the street, but in a different city. And if you think about it, Think about this as back to my analogy on the stock market previously. You used to sit around and say, well, I'll invest in some company. And the closest thing that you would get to it is some other company that was like right next to it or in the same industry. Because a lot of companies get built up in cities right down the street from one another. And so you would sit there and say, well, the closest comp to that is that. Well, we all know that's kind of silly. It doesn't make a difference where you're based. It's the fundamentals of your business. What's the closest business that looks like your business from a comp standpoint? So we've expanded that and we've automated 80% of the process. And by expanding 80%, automating 80% of the process, we now need to hire far fewer appraisers. They're being far more efficient. They're doing more business. So they make more money and we make more money. So that's the kind of stuff that we're investing in that's really very transformative to our business.
Yeah, it's been remarkable just as an originator where, when we do the volume we do with the clients that are moving as quickly as we want to retain, as an originator, I want to retain as much market share of that customer's business as possible. If I'm grinding on one deal to figure out where the comps are and expense comps and all that, I can't go as fast as they need to go to retain all that business. So the technology has enabled us as originators to really, in that lens only, just to be incredibly dynamic and move quickly and stay on par or ahead of the client's needs. So we are about time here to open it up for questions. I certainly could go on with many more, but in the interest of time, we'd love to hear from you all. So please unmute, speak up, or use the chat feed, please.
I actually have a few questions. If I could jump in.
Yeah.
So we've had an interesting, 12 months, particularly with regard to yields and the 10-year bond. And I'm really curious because we're talking about commercial real estate and there is a need for some pretty substantial loans on these types of properties. How do you see the yield as people are going for it? They're looking for it in the equity markets because they haven't been able to find it in the bond market the same way. How is this, as the yields maybe grow just bit by bit, and they have been, how is that affecting your business as you see going forward?
So it's a really good question, Stephanie. So we base all of our financing off of the 10-year treasury. So that's the base rate for everything that we lend upon. What you've seen as the 10-year has gone from 90 basis points to 100 and I don't know where it closed today, 120, 1.27%, 1.30. I don't know whether it closed above 130 today. But what you've seen is as that 40 basis points has come into the market as it relates to the base rate, spreads have collapsed. So as Stephen is pricing deals, as much as you've seen the 10-year move from 90 basis points up to 130, generally speaking, we're still pricing debt somewhere between a 325 and a 350 coupon, which is basically kind of the band that we've been in. Depends on where the property is and what the sponsor is and what the leverage level is. And so that will vary quite a bit as it relates to what the overall coupon rate is. But it has been very interesting to see how, as the base rate has moved up, spreads have come in, which your question was very sophisticated, Stephanie, but I just want to say that the point there is that investors who are getting more yield in the base rate are willing to take a lower spread to buy that security. And so to exactly your point, the market has an insatiable appetite for yield right now. And so as you see yields on the 10-year move up, buyers are taking less in their spread to buy that security. And so at the end of the day, if we stay in just take 1 to 2% 10-year treasury, we can do a tremendous amount of business. And it's hard for me to say this, but I think if you start moving over 2% base rate with all the spreads that go into it, you're going to get yourself into coupon rates that are over 4%, and you're going to have to get an adjustment to cap rates to be able to make deals work again. Because that's the real issue. Right now, we're still in a positive leverage environment where people are buying things at a cap rate, which is above the cost of debt. If all of a sudden right now we're in a 4 to 425 cap rate environment for multifamily, and you're putting 325 to 350 debt on it, If that 325 to 350 trends up to 4 to 450, you've got to get a resetting of cap rates, or else you're not going to have people buying new assets. And the one thing I would put out there is if you look back to 2004, 2005, we were in an inverted yield environment where the 10-year treasury was between 4 and 450, yet multifamily cap rates between 4 and 450. And so people were borrowing at a cost higher than their cap rates, which all of you know doesn't make a heck of a lot of sense unless you're buying on the appreciation you're going to see in the asset. And many of them did. And many of them made out like bandits by buying it. But a couple of them also ran into a brick wall in 2008 and 2009.
So basically what you're saying is, even though basically the cost of money is going to slowly go up, and we're seeing that, people are willing to take a haircut on some of their profit potential going forward. There's still enough money and there's still enough motivation. You're not seeing any walls or speed bumps right now going forward.
Yeah, no, there's tons of liquidity, tons.
Thank you. Okay.
And just as a quick aside, I learned from Barry Sternlick, who's one of the savviest real estate investors in the country. Barry and I had a big debate one day back in, I can't remember the year, but probably about 8 years ago, where I said to Barry, there's not going to be enough debt capital to deal with the refinancing volumes that are coming up in this and that. And Barry looked across the room at me and said, Willie, there will be plenty of capital. And he was exactly right. A lot of capital out there seeking deals.
As an originator, you know, in multifamily, you kind of think Fannie, Freddie, FHA first in terms of that core product, because that liquidity is generally always there. The past 6 weeks, you know, CMBS market has really gotten competitive. And to your point, Stephanie, yields and those spreads that Willie was just speaking of have compressed to where they're winning deals that Fannie and Freddie, for example, either don't have the credit appetite for, or sponsor risk for, or some combination that they've backed off, and CMBS is winning more multifamily right now, which has been an interesting, you know, recent dynamic. And that ebbs and flows through market cycles.
Hey, Willie, thanks so much for joining us, and Stephen too. I'm skipping a sustainability class to be here today, and I promised my professor I would ask this. What do you think is the driving impetus in creating environmentally sustainable developments? Conversely, is there a biggest hurdle that you see?
So it's a great question, Brian, and we're very focused on a couple things: affordable housing and, if you will, environmentally positive housing, and we have some very big and explicit goals on both of those. I was watching 60 Minutes on Sunday night with Bill Gates talking about all that he's doing from a climate change standpoint. And two of the stats they talked about were that, I think I'm going to get this wrong. Yes, that the built environment adds 8% of carbon emissions, and that the construction industry adds another 7%. And so that on an annual basis, the built environment adds 15% to total carbon emissions globally. And one of the big things that Bill Gates was focused on was investing in this concrete company where they're inserting carbon into concrete to try and reduce the carbon emissions from the concrete. And one of the stats they talked about was just the millions and millions and millions of square feet that are going to be built around the globe between now and 2030. And it was something like a new New York City being built I thought it was even more than every year. Even every year sounds high. Maybe it's every week. But the point being is that the built environment adds a lot to environmental degradation. So we're very focused on that. We were Fannie Mae and Freddie Mac's largest green lender 2 years ago when they really focused on green lending, and we focused in on finding green loans. And some of the things they've done as it relates to low volume water usage in the units, putting in LED lights and other things were big drivers of savings, not only for the owners, but also for the tenants. And so we see a significant focus on that. And that's all part of our ESG goals. And Walker & Dunlop is already carbon neutral. We buy offsets on an annual basis. We're trying to drive our carbon footprint down by 10% between now and 2025. as we continue to add more and more employees. So that's a real trick because we're growing the company a lot faster than 10% a year. So we're adding more people who put in more stress on the environment by traveling and by using office space. And we want to bring that down by 10% while still buying carbon offsets. And then I would also say on D&I, diversity and inclusion, we've been very, very straightforward and very proactive on diversity and inclusion for many, many years. And so when our world erupted last summer with the murder of George Floyd, Walker & Dunlop was already well ahead as it relates to both recruiting, promoting both women and people of color into both management positions as well as our highest earning positions. And we will continue to be a leader in the commercial real estate space on those issues.
From a real estate standpoint, Brian, I'll add, I'm involved with a new company right now. A friend of both Willie and I left as CFO of one company to go head up real estate at Juno Residential based out of San Francisco. And they are mass timber construction and looking to build multifamily up to 12-story and really 4 and 5 story garden or even podium construction. They're looking to really kind of compete with mid-rise. And over time, the cost savings of that, the A&E design, it's not only mass timber, but it's also componentized. So the supply chain of how that product arrives on site and the general contractor assembles it, the thought process is going to squeeze the construction time frame down, saving on interest carry, and effectively lower rents to be able to compete in urban core. So the value proposition we're still working on, we're going out to raise GP capital for their deals, and they've got a new pipeline of projects. So it's super exciting for me as an originator to work with a very innovative sponsor on sustainable development.
Hey, Willie and Stephen, thanks so much for your time today. Always enjoy your webcast, and you've got a great reputation in the market. See a lot of the same properties in my position in CRE at US Bank. You mentioned how your business is predicated mostly on transactions, and there's both fiscal and monetary policy potential changes that will make it less favorable to transact in the future. You've got all signs pointing to lower interest rates for a longer period and less early term refinancings, and increase in taxes across the board, 1031s, estate tax, step up in basis, those things potentially going away. So how are you advising your clients knowing that those things could happen, and how are you adjusting your business model today to prepare for what might take away from the volume that you've been able to grow with?
Willie, you're on mute.
All right, I'm sorry. I got it. I got it. Oh, and it's a really good question. Here's the sort of the net to that. None of us knows what's going to happen. So you can't sort of, I mean, I'll give you an example. I put in place for my family last year some estate planning because I think there's a very good chance that the estate tax and the amount that's exempted from the estate tax comes down. Good move, I think, but the tax code hasn't changed from $11.5 million per person as it relates to the amount that is tax exempt from a gift standpoint and reverted back to the old $5 million number. But we were proactive on it and decided we'd do that in 2020 to make sure that if and when it happens, we're prepared for it. The issue with commercial real estate is that the tax code can change as it relates to 1031s. That will likely take away a little bit of the volume for what I call dentists and doctor groups who own commercial real estate and are owners and then like to roll those profits into another property. That will hurt them. It doesn't hurt Blackstone at all. It doesn't hurt Cortland Partners at all because they're not 1031 exchange users. They're not holding assets for a long period of time. They're funds. And so this gets back to the institutionalization of commercial real estate. Our client base is institutionalized. Yes, we do that one-off loan for an owner of an office building or an apartment building that they want to hold forever or sell and then roll over in a 1031. But at the end of the day, that's not going to put downward pressure on our business. And the other piece to it all is the refinancing numbers for the next 5 to 7 years are incredibly strong. And so one of the things to it all is people, unlike the single family space, commercial owners can't just sit on their hands. That debt terms, the average, as you well know from your time at US Bank, the average commercial real estate loan is somewhere around 7 years, because you're doing some 5s, you're doing some 7s, you're doing a lot of 10s, but it's all somewhere around 7 years. So every 7 years, regardless of whether you want to hold the asset forever or sell it, you got to do something. And so the point being there is, because we have a sales group, because we have a mortgage banking group, and because we have a banking group, we can hit any kind of need of the customer. But the beauty of the commercial real estate industry is that there are these cycle times that are there much, much, much tighter than the single family world. I mean, I refinanced my home last year here in Denver, even though I'd only bought it the year before. I turned around and redid it as soon as rates came down. Why? Because it cost me a couple fees to redo it, but I had no prepayment penalty on a 30-year fixed rate mortgage. 30-year fixed rate mortgage. It goes, it's gone. In our business, in commercial, I couldn't have done that. I would have had to have paid a huge, huge prepayment penalty to get out of that existing loan to move into another loan with a lower coupon rate. So it's a great question, but we feel extremely good about the volumes that we're seeing. And the final piece I'd say to it is, if you're a big incumbent lender who has a big portfolio and you're not being nearly as aggressive in the people you hire, like Stephen, or the technology you're providing them with, I think you got issues. I think there's a company like Walker & Dunlop's that's so relatively small. We have 15% of Fannie Mae's business last year. We had 8% of Freddie Mac's business last year. On a combined basis, we were about 12% market share with the agencies, which is the largest. Actually, CBRE is 12.1, where they did 20 billion, we did 19.6 billion. But then if you look at the broader commercial market, we have 2% market share. For a company that has grown as fast as Walker & Dunlop has, with the brand we have and the people we have and the technology, our ability to keep growing is almost limitless. And I don't think that's the same thing for a JP Morgan or a Wells Fargo.
We've got time for just a few more questions. We're right just before 3 o'clock, but those of you, if you've got a couple burning questions out there, please, let's take the time to get them answered.
Yeah, I got one right here. Hi, Willie and Stephen. Thanks for the presentation. I wanted to ask you real quick, because I know you'd mentioned previously that your company really focuses on affordable housing. And I recently read that Walker & Dunlop obtained around 20 million for affordable housing projects in Washington, D.C. Can you talk more about how that might be able to be compared or reapproached similarly to the housing market in Denver, and whether or not you have any ideas on what's the best method towards obtaining affordable housing here in Denver?
So Johnny, as quickly as I can, first of all, we've done $17 billion of affordable lending in the last 3 years. 17 billion with a B. So we do a ton of affordable lending. That one project that you're talking about in DC, really great affordable housing project. At the end of the day, we need more affordable housing in America. We do not have enough affordable housing. And so back to my very early point as it relates to single family versus multifamily, single family rental, affordable housing is needed. There is so much demand for it. And the federal government is doing a lot, from the Trump administration into the Biden administration, as it relates to getting Fannie Mae, Freddie Mac, and HUD to focus on financing affordable housing. And the final thing I'd say is that sort of back to Owen's point as it relates to tax changes, if we get an increase in tax rates, people are going to want to look for ways to get around paying high taxes. And tax credits are an extremely good way to do that, to offset your tax exposure. And tax credits are kind of a component part of affordable housing that has been used across the country to raise equity. And so what you likely will see is, as tax rates go up, more and more tax credits being put out there, there being a very robust tax credit market, which then provides cheap equity capital to go into affordable housing projects. So there is somewhat of a virtuous cycle there that ends up getting capital going towards affordable housing. And Fannie Mae and Freddie Mac specifically have extremely high mandates from their regulator to put first trust debt, very cheap first trust debt on affordable housing. So
Yeah,
it's
and
a great
a
space.
couple other, opportunity zones, social impact investing. Many developers are trying to find a way to deliver affordable housing without being the necessity of tax credit financing. And so more to come, but obviously big focus for everybody. All right, Bob,
I think I saw Adam go off of mute. Adam, did you have a question?
Oh, thank you, Willie. I did actually. And Stephen, guys, this has been fantastic. I really enjoyed your focus on data analytics. And I was curious, I agree with you that working from home doesn't have the same benefits as being in the office, but we are seeing a lot of large institutions permanently going to remote work. And I agree that tax incentives can be a pull for these populations, but I see that more as a lagging indicator. So I'm wondering, are there any more proactive measures or tactics that you and your team are taking to kind of project where these populations are moving to?
Well, first of all, a lot of our clients just track U-Haul. One-way U-Haul is like a big indicator. The other is sort of FedEx deliveries, UPS deliveries, where you're getting more and more economic activity. But the one as it relates to where are people actually moving, U-Haul one-ways is the easiest way to figure out where people are going. I think the issue with back to the office and remote work is that you're exactly right, Adam, that a lot of companies have come out and said, hey, we're going to let, Google said you can work from wherever you want. I had on my webcast with Owen Thomas of Boston Properties back in December, Owen said, as these big companies like Google and Amazon and Facebook all say people can work remotely forever, they're the biggest takers of office space in Boston Properties buildings. So the point being is that they're so big and they're growing so fast that they need to both have physical space as well as remote space, and they're going to manage their workforce accordingly. Right now, we're not budgeting at Walker & Dunlop $1 of savings as it relates to physical rent cost in 2021 or 22 versus 2020. Not $1. That does not mean that I don't think that certain people are not going to work a flexible work schedule. I typically, right now, my son goes to school right next to DU. So I go by St. Anne's every morning. I drop my son off at school and I come into the office. I get here around 8:20 after dropping him off at 8. I'll leave right after this call is done. I've got 3 more Zoom calls today, but I'll drive home in the next half an hour. I'll get on another Zoom call. I'll do another Zoom call. But when I'm done, I'm home. And I'm also not dealing with rush hour traffic. So I think that kind of coming into the office and seeing people and interacting and having a face-to-face meeting or a team meeting, and then going home and using Zoom in the afternoon still means we need this square footage for me to come in and physically be here. But it also says that I don't have to worry about the commute. And I think one of the other things to Stephen's previous question about where are people moving versus urban and suburban, and when we all get back into the office, are people going to want to be back in the urban core? If you want the flexibility of what I just talked about, you don't want to live an hour away from your office. You don't. You want to live a lot closer. So that flexibility of being able to be in the office and then go home and use both flexibly with Zoom only happens if you're not sitting in your car for 2 hours to get to your house. So I think there's a lot to be determined as it relates to what office and homework are going to look like. But I'm still a firm believer in culture and community, and culture and creativity, and they come from being face-to-face with people.
I agree. Very insightful. Thank you.
Yep.
Okay.
You
Everyone,
good, Barb?
I think we're about at the end here. That was fantastic. I really want to thank everyone. I always track like how long people stay on the Zoom call, and quite frankly, we hardly lost, but I think 1 or 2 people, and that was at the very end. So that was a great job, folks. I really appreciate it. And so I'm just gonna, we're a little over time, but I still want to say, if there's any last words of wisdom, Stephen or Willie, you'd like to share, have at it, and then we'll wrap it up and we'll share a little bit with these alumni and students about our next event that's coming up next month.
Sure, I'll jump in real quick and let Willie have last word here. I'll just share, Willie touched on it earlier, and I'll just kind of share my own personal perspective. You know, I was at DU wrapping up my last quarter when 9/11 occurred, and I was working for a developer. I wanted to be a developer. I had student loans. I didn't have the ability to go drop a bunch of equity in a new project. And so working for actually a friend of DU, David Johnson at Eck and Johnson Group. And he said, Stephen, you need to either pick your spot of investment sales or banking. He said, you need to either, you need to meet as many people as you can, and you need to see as much transaction volume as you can. And that was the launching pad from development into mortgage banking. And I've been thrilled with that. I thought I was going to miss the touch of the physical asset, but your reality is I get to see it through the lens of my development clients. And so I think that was just a little words of wisdom that I got there in Denver 20 years ago. And it has done me well.
So I would just say, first of all, it's been a pleasure, and I'm appreciative of everyone taking the time. I would also say to Barb and Cece, thank you for having us on, and Stephen, thank you for putting this all together. As Susan Weber, who's on here with me, knows, our webcast typically has between 3,000 and 5,000 people on it. And so to be honest with you, I love talking to a group of 22 people and not 2,200. The second thing is that I can't underscore enough. Figure out what you like to do. And you don't know until you try. So try different things. Don't think that you've got to figure out exactly what you want to do and that's where you want to go. Stephen just said he wanted to be a developer, and all of a sudden now look at him. He's one of the very best bankers in our industry. The third thing is work with people you like working with. You'll all work with jerks. I guarantee you'll work with jerks. Find a place where you're working with good people. Life is way too short to put up with working with jerks for a very long period of time. You'll have to work to some of them. I told you I worked with one jerk for 5 years. He was my boss. And I learned more from that jerk than I probably have learned from anybody else. So there's always something to be learned through those experiences. And the final thing is just, I had a really fancy job with a really, really successful private equity firm. And I realized that I didn't want to be, not that I didn't want to be on the deal side. I'd started a firm previously, and I knew I wanted to be a general manager. I knew that what I really enjoyed doing was interacting with people, building teams, and building companies, and not just doing deals. And that's not to dismiss. I do deals every single day. I do deals with Stephen every single day. I'm a deal guy. But at the same time, what I really wanted to do was build a company. And one of the great joys for me is having built this incredible company with an incredible brand, incredible people, and incredible track record of financial success. And the reason I underscore that is that some of you will have that entrepreneurial bug. And if you've got it to the degree you can, I'd say pursue it. Others of you don't have that in you, and you want to be more of, I'm going to be a finance person. I'm going to be a salesperson. I'm going to be an investor. I'm going to be a builder. I'm going to be this. I'm going to be that. Then pursue that and see how you get feedback on what you're good at and what you're not good at. And the final thing I would say is dream big. I was just on a call this morning with Fidelity, who owns some of Walker & Dunlop stock. And I was talking to them about the transformation of Walker & Dunlop from being a itty bitty public company in 2010 with a market cap of $220 million. And at that time, we set the ambition of being the premier commercial real estate finance company in the United States. And every single one in the industry would have had all the right in the world to look at me and say, you are one arrogant, out of touch guy as it relates to the size of Walker & Dunlop and what your capabilities are at Walker & Dunlop. $220 million company doing a couple $2 billion a year of financing. 10 years later, we're right on the path to being the premier commercial real estate finance company in the United States with a market cap of over $3 billion. But the reason is that we've gotten to 3 billion is because we were stupid enough, arrogant enough, and naive enough to think that we could do it. And so I just say, you know, as you focus on your careers and where you're going to go, think big, figure out what you like doing, and good luck.